Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Pfizer stock so we can determine if it's a buy or a sell. Pfizer is a pharmaceutical and biotechnology company. The company was established in 1849 in New York by two German entrepreneurs, Charles Pfizer and his cousin, Charles F. Erhardt. They develop and produce medicines and vaccines for immunology, oncology, cardiology, endocrinology, and neurology. Its biggest product in 2022 was its COVID vaccine. That generated $37 billion of revenue. It does have other drugs with annual revenue above $5 billion and several above $1 billion. The company is headquartered in New York, New York, and was founded in 1849. Let's get started with the model. This is a large cap company, 212 billion market cap. They're trading at $37 a share and they have 5.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. This company grew a ton during COVID. In 2019, their free cash flow was $10 billion. It jumped way up to $30 billion in 2021. It dropped a little in 2022 to $26 billion. But still, $26 billion is a huge number. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that doubles from $16 billion to $31 billion. Revenue is a sales for the company, and that also doubles from $51 billion to $100 billion. Let's look at their capital structure. They have $95 billion of equity, $35 billion of debt. They're 73% equity, 27% debt. Their net debt is $12 billion. So that means they have $22 billion of cash on their balance sheet. I gave them a WACC, a weighted average cost of capital of 8.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $329 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $300 billion. We divide that by 5.7 billion shares. And we get a calculated stock price of $53. They're trading at $37, so they're trading at a 29% discount. It's a buy according to the model. Simply Wall Street is at $91 a share. They're saying they're 59% undervalued. 11 analysts priced this stock and the average price target is 43, the lowest 38, the highest 49. 23 more analysts priced this stock and the average price target is 47. They say it's 27% undervalued. This is where the stock has been trading from 1980 to 2001. You can see they always pay a dividend. The stock was growing steadily from 1980 to 1996, but then it really shot up. It went from $10.96 to over $45 3 years later. It did drop to the low 30s. This is around the dot-com crash. It came back up to 45, and for the rest of 2000 it was trading between 35 and 45. This is where the stock has been trading from 2002 to current. So if you bought the stock in 2002, you'd be flat right now. After 21 years, the stock would not have gone up. You would have still made decent money from your dividend payments though, but the stock price would have been flat. It did drop down to about $12 during the Great Recession. It almost hit 45 in 2019, then fell below 30 during the COVID crash. Then they had their post-COVID surge, getting close to $60 a share, their all-time high. But it's down about 30-35% from the peak at $38. I bought the stock mid-2020, and I was up a ton after a year, about 50-60%. But now I'm pretty much flat on my investment. They pay a quarterly dividend and they always pay it. It was 32 cents in 2018, then 34 in 2019, 36 in 2020, 39 in 2021, 40 in 2022, and 41 in 2023. That's a yield of 4.4%. To calculate the yield, you multiply the last dividend payment by 4. 41 cents times 4 is $1.64. And you take that number and divide it by the current stock price. That's how you get to 4.39%. And they could afford this. It's 36% of their free cash flow, 30% of their net income. So about 2 weeks ago, they released their first quarter earnings, the first quarter of 2023. As you can see here, Pfizer stock jumps after sales beat forecast. Pfizer delivered solid first quarter results. Earnings were just short of the estimate, but revenue was well ahead of expectations. The main driver for the revenue beat was the COVID-19 vaccine. They're still pulling in good money from that, which came in much higher than analysts predicted. Pfizer maintained its full-year outlook for COVID-19 vaccine sales, despite speculation that those estimates might come down. The company is on a merger and acquisition spree. This is a really big deal, $43 billion acquisition for biotech company Seagen. Let's dig into the 10Q. This is for the first quarter of 2023. Each year, U.S. companies issue 3 10Qs and a 10K. 10K is for the entire year, for that company's fiscal year. Their fiscal year end is December 31st. So the 10K is issued for the 12/31 financials, 10Q is 3/31, 6/30, and 9/30. Right in the beginning of the 10Q is a table of contents. So if you want to jump around between sections, like you want to look at the MD&A, the management discussion and analysis, you could just click on that link and you see it brings you right to that section. We'll just focus on their financial statements. We could look at the income statement, the balance sheet, statement of cash flows. That's what I usually look at. Once in a while, I'll look at the statement of changes known as equity. I don't really look at the statement of comprehensive income too much. I did do a video on that explaining what it is. But let's jump to the income statement. So for the first quarter, their revenue was $18 billion, down a lot from $26 billion. But they did beat the estimate, so that's why the stock went up. The analyst's expectation was the revenue would be below $18.3 billion. Their cost of revenue was $5 billion, half of 2022. But their revenue was a lot higher than half of 2022. So that means they're improving their margins. They're more profitable. Cost of revenue are all the expenses directly related to generating the revenue, like the payroll for the people who make the drugs, also the rent for the factories where the drugs are made. Selling and administrative expenses, $3.4 billion. That is up from 2022. R&D, $2.5 billion. Amortization of intangibles, that's $1.1 billion. So their operating income is $6.3 billion, down from $9 billion. They spent $700 million in taxes. Net income of $5.6 billion. So that's an EPS of $1. Last year was $1.40. They pretty much have the same shares outstanding. It's 5.63 billion. Last year was 5.62 billion. If you want to get detail on any of these numbers, what I do is I just copy the number and search for it. So I'm searching for 18,282 in this document. So if I want to know what feeds into that 18.2 billion, this doesn't give me much info. It says 18 billion from biopharma, 300 million from other. I'll search more. I'll search again. This is interesting. I could see 8.5 billion is from the US. So revenue in the first quarter in the US was 8.5 billion, about 45% of their total revenue. 3 billion in developed Europe, 2.5 billion from developed rest of the world, and emerging markets 4.5 billion. They only decreased 5% in the US, but 50% in developed Europe. An overall decline of 29%. Now let's search this number again. So this is really good information. It gives me a breakdown on revenue per drug. This screen is a little small, so you may need to zoom in. Paxlovid, that's the COVID-19 vaccine. That was their biggest revenue generator, $4 billion, which is up from 2022. That's interesting. It was $1.5 billion. Eliquis, you've probably seen commercials mentioning this drug. That was $1.9 billion, up a little from 2022. Their revenue in primary care drugs, which are these, was $11.5 billion in 2023. Last year, in the first quarter of 2022, it was $19 billion, so it's down a lot. It's mainly down from this, $13 billion down to $3 billion. I think that's the COVID vaccine. I guess this top line is COVID vaccine for high-risk patients. This second line is not for high-risk patients. In specialty care, their revenue is up from $3.5 billion to $3.6 billion. Vyndaqel is their biggest, that's $700 million, up from $612 million. Oncology is down a little bit, from $3 billion to $2.9 billion. Oncology is a treatment of cancer and tumors. Ibrance is down a little bit. That was 1.2 billion. Now it's 1.1 billion. And this is the next page. More oncology drugs, the smaller ones. In the category business innovation, they had revenue of 310 million. Most of that is Pfizer Center 1, 306 million. And if you want detail on any of this, on what these drugs are, you can just search for this name in a document or Google it. They also have notes in the document to give you a little more info. Let's go back to the income statement. You can see in cost of sales, the 4.9 billion, there's a footnote A. Footnote A says exclusive of amortization of intangible assets. So the 4.9 billion does not include the amortization of intangible assets. They break that out separately here. And if you want to know what the 1.1 billion represents, we can just search for that number. And it brings us here, but it doesn't really tell us what it is. It's still the same thing, amortization of intangible assets, 1.1 billion. So we didn't get much information searching for this dollar amount. Let's search for the words amortization of intangible assets. Okay, here we go. Amortization of intangible assets increased 268 million, mainly from the acquisition of Biohaven and GBT. And that's partially offset by fully amortized assets. Pretty much the only way to get intangibles on your balance sheet is through acquisition. You could internally generate an intangible asset, but it's not too common. It's a bit difficult. Most of the time it's from acquisitions. Let's see if we search Biohaven if they have more detail on that. And it's right above it on the paragraph before. Acquired in-process R&D expenses decreased 334 million, mainly from an upfront payment to Biohaven and a premium paid on our equity investment in Biohaven, 263 million. So when they acquired Biohaven, that company was in the process of researching and developing a drug. Let's just say, for example, Pfizer paid $10 billion for Biohaven. But according to Biohaven's balance sheet, they were only worth $7 billion. So investors ask, why are you paying $3 billion more than what the company's worth? And Pfizer may say, because the company has been spending a lot of time developing a certain drug, and they're getting really close to commercialization, but they haven't recorded that dollar amount on their balance sheet. So that's considered an intangible asset. It's not tangible. There's a lot of value there, a lot of intellectual property, a lot of value there for the knowledge Biohaven has uncovered over the years. Because it is common for a company to pay a lot more than another company's worth. But intangibles are a little tricky. You're valuing maybe the brand name of the company. You may have to also value the knowledge the company has built up, the employees. That's an asset, but it's not directly on the balance sheet. Let's go back to the beginning of the document. We'll go to page 2 or 3. And now let's go to the balance sheet. We'll click the link. The balance sheet is a snapshot at a point in time on what the company is worth. There are 3 sections on the balance sheet: assets, liabilities, and equity. The value of the company is assets minus liabilities. So you can see they have 2.2 billion of cash on their balance sheet as of 4/2/2023. 18 billion of short-term investments. If you're curious what this is, let's just search that number. 1.2 billion of equity securities, so maybe they own stock in other companies. 16 billion of available for sale debt securities. Available for sale is just when a company buys a debt instrument that they plan to sell before maturity. An example is if they bought a CD, certificate of deposit. The 17.8 billion are short-term investments, investments which are likely to be liquidated within 1 year. Then you have long-term securities, 3.6 billion. Let's go back to the balance sheet. I'll show you where that 3.6 billion is. So it's right here, 3.6 billion. That's in the non-current asset section. Non-current assets are assets that are likely to be liquidated beyond 1 year. And we could see a breakdown of the 3.6 billion. 2.4 billion in equity securities, 300 million in debt securities available for sale. Then they have private equity securities, 800 million. So these are companies that aren't publicly traded. Let's see if we can figure out what this $2.3 billion is. When I search the 2.3 billion, I get a lot more detail. Remember the 16 billion of available for sale debt securities? If we want even more detail on what that is, 13 billion is non-US government securities, 900 million in US securities, and 1.9 billion in corporate. But I can't find the detail on this 2.3 billion. I was curious what equity securities they hold. It might be somewhere else in this document, but I don't want to spend that much time on this. Let's go back to the balance sheet. They have 12 billion of accounts receivables. This is how much money other companies owe them. 9 billion of inventory. Let's search that 9 billion. 2.7 billion is finished goods, 6 billion work in process, and 755 million on raw materials. So manufacturing companies have to break down inventory into 3 buckets. So finished goods means they finished manufacturing the drug or vaccine. It's ready to sell to the customer. Work in process means they're in the middle of manufacturing it. They haven't finished it yet. And raw materials is before work in process. It's just materials and supplies sitting in boxes waiting to be used. And you can see inventory is up a little bit from 9 billion to 9.5 billion. And it is footnoted here, A. The increase is from Paxlovid, and also for certain products due to supply recovery and inventory build. Let's go back to their balance sheet. So they have $50 billion in current assets, down a little from last year. I like to look at current assets over current liabilities, the current ratio, and you want that to be above 1. In their case, it's about 1.5, because 50 over 36, well, if you want to do the math real quick in our heads, 50 over 36, that's 1, and 14 over 36. So 14 over 36, we can reduce that to 7 over 18. We know 9 over 18 is 50%. 7 over 18, maybe it's 40%. So their current ratio is about 1.4. The current ratio lets you know if a company can pay a short-term debt with its current assets. And in their case, they can. Now let's look at their non-current assets, equity method investments, 11 billion. Let's search what that is. We don't get much information from searching the number. Let's search for the words, equity method investments. Okay, here's some information on equity method investments. A company uses equity method investments when they own part of another company. They have to record that other company's profit or losses onto their income statement. It's usually used when a company owns between 20% and 50% of another company. And they mention their equity investment is mainly from Haleon stock. If you go to Yahoo Finance and search Haleon, you'll see it's trading at $873 with a $40 billion market cap. So they're reporting 11 billion, so maybe they own about 25% of this company. Let's go back to the balance sheet. They have long-term investments, we talked about that already, and they mentioned PP&E less depreciation is 15.5 billion. So they depreciated 1.5 billion from those fixed assets. Identifiable intangible assets 42 billion. Let's see if we could search this dollar amount. So the 42 billion represents developed technology rights, brand name, which is really nothing, because the companies they're acquiring probably don't have much of a brand name. What they really want from those companies are the drugs, all the information they gathered over the years developing drugs. 1 billion in licensing agreements, 800 million in brands, 11 billion of in-process research and development. When it's finite, these assets are amortized annually. When it's indefinite, that means they're not amortized, but they are tested for impairment. Then you have deferred tax assets, that's 7 billion. A deferred tax asset is usually the result of an overpayment or an advance payment on taxes. So this will help reduce their tax bill in the future. It's carried as an asset on the balance sheet to be used at a future date. That's why they use the word deferred. It's being deferred into the future. So total assets is 196 billion. Then you have liabilities. Short-term debt is 4.2 billion. Accounts payable, how much they bought on credit from other companies, 6.1 billion. Income taxes payable, 2 billion. These are taxes that are due to the government within 1 year. This doesn't mean they're past due on their taxes. This is more of a timing thing. So over the next quarter or two, they'll probably pay most of this, and then it'll be removed from the balance sheet. Accrued compensation of 2.3 billion. This may be bonuses they promised to executives, but they haven't paid yet. Deferred revenue of 1.8 billion. If a company paid them $100 million for COVID vaccines, But Pfizer won't be able to deliver the vaccines for another 3 months or 6 months. They have to record the cash and book a liability. They book deferred revenue, which is liability. And when they deliver the vaccines, then they remove the liability from their balance sheet and book it onto their income statement as revenue. They can't book the revenue just because they receive the cash. They have to wait till they deliver the product. Then you have other of $20 billion. So current liabilities are what they owe within 12 months. That's $36 billion. Non-current is what they owe beyond 12 months. $31 billion of long-term debt. Let's search that. I don't see a breakdown of their long-term debt. It's usually broken down by year. How much debt is due each year? They probably list that detail in a 10K. The 10K has more info than the 10Q. Total liabilities of $94 billion. Let's look at their equity. Additional paid in capital. That's $92 billion. This is how much money the company raised from issuing common stock. And you can see they buy back lots of stock. They bought back $114 billion worth. But they're still really profitable. Their retained earnings are $130 billion. Retained earnings are the sum of the company's prior net incomes minus the sum of the dividends they paid out. So the total equity, $100 billion, which is assets, $195 billion, minus liabilities, $95 billion. So that's the value of the company according to the balance sheet. Now let's look at the most important document, the statement of cash flows. It's broken out in 3 sections: operating, investing, and financing. So in the operating section, it starts with their net income, $5.5 billion. Then we have to add or subtract the non-cash items on the income statement. We add back depreciation and amortization, $1.5 billion, because that's a non-cash item that reduces your net income. That's why we add it back here. They had $600 million of deferred taxes, which improved their net income, so we minus it out here. Then we have to adjust for changes in working capital. So if they bought product on credit, used accounts payable, that's a cash inflow in this accounting period. If they used inventory, that's a cash inflow. But if they bought inventory, that's a cash outflow. We minus it out. They had a negative $5.5 billion in working capital. So their operating cash flow doesn't look so good. It's only $1.2 billion. Maybe that's why the stock has gone down so much the past few months. That's how much cash the company generates from its operational business. They had a cash inflow of $3.3 billion from their investing section. They purchased $1.1 billion of property, plant, and equipment. That's a cash outflow. They bought $6.7 billion of short-term investments. They sold $6.4 billion of short-term investments. They received another $4.7 billion from short-term investments. They didn't do any acquisitions in the first quarter, but last year they had a cash outflow of $6.2 billion from acquisitions. In the financing section, it's all the changes in debt and equity. So they received $11 million from short-term borrowings, so they took on debt. They received another $226 million from short-term borrowings. They paid $269 million of long-term debt. That's a cash outflow. They paid out $2.3 billion of dividends in the first quarter. So that a cash outflow of $2.8 billion in the financing section. There's this great website I use, businessquant.com, and they give you a ton of information. You can use their stock screener. They have all the financial statements for pretty much all public companies. There's a section called Industry Stats. And when you check off the industry drug manufacturers general, it gives you all 15 companies that are publicly traded in that industry, and then whatever statistic you want. I chose all the stats. There's about 250 different ones. Let's see how much we can get through. This top line shows you the average for all the companies. If you want this entire file or any of my files, you can just go to Patreon. It also has a DCF model that you can use. Accounts payable is how much you owe other companies. They're $6.8 billion, average is $7.1 billion, so they're right around the average. Accumulated other comprehensive income, these are unrealized gains or losses. This number is reported in the equity section of the balance sheet. Unrealized means you haven't realized a gain or loss. It's like if you buy a stock and it goes up $1,000, you didn't make $1,000. When you sell it, you'll realize $1,000. But before you sell it, you have an unrealized gain of $1,000. The asset turnover ratio, this is revenue over assets. The higher the number, the more efficient the company is at using its assets to generate revenue. They're right at the average, 0.5. Non-current assets, these are assets that are going to be liquidated beyond 1 year, like PP&E, buildings, goodwill, that's all part of non-current assets. They're at 145 billion, a little more than double the average. Book value per share, that's the equity on the balance sheet over the shares outstanding. So if you own one share of this company, in theory, you own $17 of book value, $17 of equity. $19 billion of business acquisitions and disposals. It looks like they spend the most in acquisitions. CapEx as a percent of revenue. CapEx are investments in property, plant, and equipment. They're at 3.2%, which is higher than average. If this number is really high, that means you're investing a lot into your business. Their 1 year CapEx growth is negative, so they're down 20%. The 3 year is down 16.5%. The 5 year is down 8%. Most companies are negative in this industry, so it looks like they were investing a lot more in the past. Now it's been coming down. Capital employed, 155 billion. This number is usually close to the total assets. The calculation for this number is assets minus current liabilities. CapEx, these are investments in property, plant, and equipment, 3.2 billion, higher than average. CapEx in US dollars. This is useful for companies that don't report in US dollars. It looks like all these companies are reporting in US dollars. Cash and cash equivalents, they're the lowest at 400 million. Average is 9 billion. The change in cash, it's down 80% in 1 year, 28% in 3 years. That's a CAGR, compound annual growth rate. Cost of revenue, that's on the income statement. These are all the expenses directly related to generating the revenue, like payroll, rent, things like that. Current assets, 51 billion, we looked at that earlier. That's cash, inventory, accounts receivables. Current liabilities, 42 billion. That's accounts payable, short-term debt. So the current ratio is 1.2. Their debt ratio is 0.2. That's total debt over total assets. Usually the lower the better for this. Debt to equity ratio, 0.4. That's total debt over total equity. Low is good. Deferred revenue, they're the only company with deferred revenue. This is when you get a prepayment for a product or service before you deliver it. Depreciation and amortization, 5 billion. Dividend coverage ratio, 3.5. This is net income over dividends. It's how many times a company can pay out its dividends using its net income. Usually the higher the better. They're at 3.5, higher than average. Dividend growth, 2.6%. Look at Eli Lilly, 15%. The 3-year CAGR for dividend growth, 3.3%. The 5-year CAGR, 4.5%. Quarter over quarter, 0.6. Dividend payout ratio, so that's dividends over net income. They pay out 29% of their net income in the form of dividends. Total dividends over shares outstanding. They pay out $1.60 per share. Their yield is 4.2%. They pay out $9 billion in dividend payments. Earnings per share, $5.50. Earnings before interest, but after taxes, 31 billion. The 1 year EBIAT growth, 43%. EBIT, earnings before interest and taxes, 35 billion. EBITDA, earnings before interest, taxes, depreciation and amortization, 40 billion. EBT, earnings before taxes, 35 billion. Enterprise value, 250 billion, about 25% higher than the average. Enterprise value is market cap plus net debt. So you take the company's market cap, that's 200 something billion, plus their total debt, minus the cash on the balance sheet. Earnings per share, 560, EPS growth, 43%. Equity multiplier is assets over equity. This means for every dollar of equity, they have $2.10 of assets. The higher the better for this. Enterprise value to assets, 1.3. That's enterprise value over total assets. EV to cash from operations, 8.6. I like to focus on cash flow from operations. That's my favorite number. EV to debt, 7.0. That's EV, enterprise value over debt. Then you have EV to revenue, EV to market cap, EV to free cash flow. Free cash flow dividend payout ratio. So they pay out 35% of their free cash flow in the form of a dividend. Their free cash flow growth is negative 13%, but over 3 years it's 35% CAGR. Free cash flow of 26 billion. Free cash flow per share is $4.60, which is lower than the average. Free cash flow to debt is 0.7. That's free cash flow over debt. They can cover 70% of their debt with their free cash flow, which is the highest of all the companies. Gross margin, 66%. That's a lot lower than the average. That's gross profit over revenue. It's how well you convert revenue into gross profit. Remember, gross profit is revenue minus cost of revenue. Gross profit 66 billion, income taxes 3.3 billion, intangibles 95 billion, a lot higher than the average. I think they have the most intangibles. Actually, no. AbbVie is the most at 97 billion. Invested capital is the amount raised by issuing debt and equity, 131 billion, which is about double the average. Investments in acquisitions, 6.7 billion. They bought back $2 billion of equity securities. So they bought back common stock. They paid back 3.5 billion of debt. Long-term debt is 33 billion, which is higher than the average. Long-term investments of 15 billion. Market cap 215 billion. They rank 7th on this list. Average is 180 billion. Cash inflow minus cash outflow, negative 1.5 billion, which makes sense. We just looked at that statement of cash flows. That's generally not a good sign. You want to have positive net cash, but they had really low operating cash flow in the first quarter. Hopefully that improves. They had a cash outflow of 15 billion from financing. You could get a negative if you buy back stock or pay back debt. It would be a positive if you took on debt or issued stock. Net cash flow from operations, 29 billion. This must be for the prior 12 months because in the first quarter, it was really low. Net income growth is 43% in the past year. Net margin growth is 150%. They have non-current liabilities of 59 billion. An example is long-term debt. NOPAT, net operating profit after tax, 31 billion. Operating income, 34 billion. This is revenue minus cost of revenue minus operational expenses like R&D, marketing. A 43% growth in operating income. So we're up to column 164. There's so much detail. You could spend the rest of your life looking at the details for any company. There's just so much information out there. Other current assets, 8.6 billion. These are liquid assets, but they're not too common, so they put in the other bucket. Other current liabilities, 32 billion. This is due within 1 year, and it's not significant to break it out by item, so they just group it all together in other. Other non-current assets, these are assets that can be liquidated beyond 1 year in the other bucket. Price to book, 2.3. That's market cap over equity. Usually the lower the better. So if you bought the stock today, you're paying $2.30 for $1 book value. PE is 6.9, which is really low. Price to free cash flow, 8.3. They have amazing ratios, Pfizer. But the market is forward-looking. So just because their numbers look great today, the market's saying they're not going to look great in a year from now, 2 years from now, 3 years from now. But of course, only time will tell. Price to sales, 2.1. So they have the best price multiples of all these companies. That means you're paying $2.10 for every dollar of revenue. 16 billion of PP&E, 11 billion of R&D. Retained earnings, we looked at that earlier in the balance sheet, 125 billion. They have the most retained earnings, even more than Johnson & Johnson. And Johnson & Johnson is so much bigger in terms of market cap. Revenue, 100 billion. They're number one in this category. Revenue growth, 23%. The CAGR is 35%. That's mainly from the COVID vaccine. ROA, return on assets. It's how well you use your assets to generate a profit. It's net income over assets. They're at 16, much higher than the average. ROE, net income over equity. It's how well you use your equity to generate a profit. 33, they're at the average. Revenue per share, $18. Generally, the higher the better for this. They're lower than the average. Selling, general, and administrative expenses. Marketing would fall into this category, 14 billion. They spend more than average. Shares outstanding, 5.6 billion. They might have high revenue, but they have so many shares outstanding. That's why their revenue per share is low. Diluted shares outstanding. This is of all the convertible securities converted to equity. 2.9 billion of short-term debt, 22 billion of short-term investments. Stock-based compensation, 872 million. They're double average. This is how much money they pay their employees in stock. The stock is down 26% in the past year. Merck is up 16%. Organon is up 30%. Their stock price is $38.30. They're down 30% from their 52-week high. They're really close to their 52-week low. Could be a great time to buy this stock. The stock's down 8% in the past month, down 22% in the past year, down 12% in the past 3 months, down 19% in the past 6 months, down 25% year to date. 100 billion of tangible assets. A tangible asset is a piece of machinery. Deferred tax asset 10 billion, deferred tax liability is 12 billion. Their tax rate is 10%. Total assets 197 billion, double the average. Their total debt is down 7% in the last year. It's down 12% in the past 3 years. That's an average. Down 4% in the past 5 years on average. Their total liability is 100 billion, a good amount more than average. Total operating expenses 31 billion, more than average. Receivables, how much money other companies owe them, 11 billion, average is 8 billion. And working capital, current assets minus current liabilities, 9 billion. All done with the video. I hope you learned something new. Please like, comment, subscribe. Talk to you soon.